All right, let's go ahead and get started. It is just past 8 a.m. in San Francisco, 11 a.m. in New York, and 4 p.m. in London. Behind me, you can see the actual text from the original Bitcoin white paper. And we'll be talking about some of the concepts from that today, actually, in our market outlook, because we have some really exciting events that have occurred over the past month, but also a few to look forward to in just a couple days. So welcome to the market outlook for April, and we're gonna kind of put on a lens and review the past 30 days to study what happened across the cryptocurrency markets, and I'm very excited to have you guys join us today. So my name is Nicholas Carey. I am the co-founder of blockchain.com, the founding commissioner of the Blockchain Commission for Sustainable Development, and the author of The Future is Decentralized. So thank you very much. I want to give everyone a quick update of what we've been doing here at blockchain.com over the past quarter. It has been a very exciting time. We've actually seen over 2.5 million new wallets created over the past couple months. This is great. We're on our way to hit almost 50 million, which will be an incredible milestone for the firm. We're seeing record traffic to the blockchain.com platform across the Explorer, the exchange, and the wallet, which has been really, really exciting. Just a couple things to point out. We've rolled out some improvements across all of the different experiences, both on iOS, web, and Android, to make getting crypto easier for everybody. And so if you haven't tested it out in a while, we'd love to have you come back and give it a shot. A couple other things to point out. You can now actually borrow cash against your crypto, which is a feature we've launched inside the wallet we call Borrow, and welcome people to give that a try. And for anyone from the press or in academia, we've completely rebuilt all of our charting and made it better and easier than ever before to use. So you got lots of new tools to study what's happening on chain, and you can visit blockchain.com and go up to the charting section to see all the things that we've worked on there. So it's been a very busy month for the team here at blockchain.com, and we're really excited about all the work that's gone into making this thing work better for everyone in our community. Okay, so without further ado, we'll continue on and to the next slide. If you haven't caught up on what happened last month, visit the blockchain.com blog. We'll be publishing this update as well as all future updates there. There's a video as well as a blog that goes into additional detail put together by our research team. And without further ado, I'll actually be welcoming my colleague today. So please welcome Dr. Gary Coleman. In this time where there's just unprecedented market volatility and an unrelenting pace of breaking news, it's just been an adrenaline-filled time. We're very fortunate to be joined by Dr. Gary Coleman. He's the head of research here at blockchain.com and one of the world's most cited cryptocurrency and blockchain technology researchers. He has created and taught the first UK class on blockchain technology at the University of Cambridge and has authored leading research on cryptocurrencies, markets, stablecoins, and broader markets. He was ranked as one of the most 100 influential economists in the United Kingdom and Ireland, and is regularly asked to share his research on all kinds of media platforms, including CNBC, the BBC, NPR, the Wall Street Journal, and he was quoted just yesterday in Yahoo, among many others this week. So please welcome Dr. Gary Coleman, who will be walking us through what we spoke about last month, and then giving us an update on where we are in the past 30 days. So welcome, Gary.
Great, thanks so much, Nick. Can you hear me okay? Just to make sure microphone's working
yep.
Well?
Hearing you great.
Excellent. Okay, well, briefly, we covered last month a number of, I think, important topics coming off of the March price drop. There were claims overblown in our view that crypto was broken, that all is bad. We think Bitcoin secret weapons. That somehow the digital gold thesis was dead. A lot to do, and really we've seen, April. I think a lot of these claims wrong. Crypto's attributes are really coming, to the forefront and are shining. And we're seeing, the broader use of blockchain technology also getting a lot of interesting attention. Discussion of voting on blockchains in Ohio. Other supply chain initiatives getting accelerated and so on. So today what we're going to talk about is, price, especially on the just a few days before the kind of Olympics, as Nick put it earlier, of Bitcoin, the halving coming up here in a couple of days. Talk about what's going on with Bitcoin. Talk about how Bitcoin is outperforming gold, but at least as of the end of April, it had not been this year outperforming bonds. Interestingly, and talk about why that might be the case. We want to spend some time in section 2 discussing Ethereum, which is actually outperforming Bitcoin, why that's happening, will it continue? Section 3 is I think something we're going to be doing more is talking about the broader stock market, and as crypto becomes more integrated into traditional markets, understanding how the stock market and stock market participants are looking at crypto, what's going on in the bond market, the stock market. These things are going to become, I think, more and more important for evaluating the crypto markets. Section 4 is some brief discussion of on-chain activity, deceivingly low transaction volumes, and what's happening with the hash rate before we wrap up with the halving or halving. We seem to use 2 terms to describe this. Maybe by the end of this call, we can settle on one and further boost the Google search performance for this important event. Further ado, let's get into why bonds. So we, in the May report that's going to go out here today, I believe, we have this chart which looks at the last 30 days in April. Where we saw Ethereum up 57%, Bitcoin up 37%, but it was a good month across the board for most major asset classes. Gold up 6%, stocks up 13%, bonds up, and year to date, again, crypto looking very strong. Gold is up 10, but Bitcoin's outperforming gold. And when you look at the low that we put in March for many of these asset classes, again, crypto is bouncing back much stronger than a lot of other asset classes. And of course, Bitcoin's still the leader over the last 12 months. So what's going on with bonds, though? I think it's worth actually trying to understand why the bond market is doing so well and even outperforming Bitcoin. In fact, crushing stocks. This is something I continue to be framed. Bonds, long-dated bonds, U.S. government bonds in particular, crush stock returns. Over the last 1, 3, and 5-year time horizons, you'd be better off, especially on a risk-adjusted basis, but even on just an absolute basis in long-term bonds and stocks. So what's going on here? Well, today with the bond market, the traditional drivers of why bonds are interesting are all looking still really quite positive. There's 3 main things that bond investors look at. One is the economic growth outlook, which is very poor and uncertain. When the economic growth outlook is positive, people tend to or should tend to want to shift into equities and higher risk, investment assets. The inflation outlook is very disinflationary. Now, that's not deflation. Deflation is when you actually have a decline in price. This is where we have a slowdown. Disinflation is a slowdown in the rate of inflation. So that's the kind of inflation outlook, at least in the short run. And then the policy outlook, you've got central banks basically putting a floor under, in the case of the Fed, the entire U.S. credit market. And you have a captive buyer. Basically, they're setting a price floor on bonds, and you have also the possibility of further negative rates. We already have negative interest rates in Japan and Germany and in much of Europe. A lot of people discounted the possibility that the U.S. Could go into negative rates. But Ken Rogoff, who I've had the pleasure of debating on panels, certainly someone I've learned a lot from, wrote a great book on the history of financial crises. Former childhood chess prodigy as well. Some people may not know that. He has a wonderful piece that we linked to in our May Outlook, making the case for why the U.S. Fed should take interest rates negative and take them down to -3%. And it's worth reading to understand just how serious I think this conversation is today around the Fed going negative and how that would be implemented. And one of the things Professor Rogoff argues is that you would need to eliminate high denomination banknotes. One of the big arguments for why central banks haven't gone negative historically is that people would simply move out of their bank accounts and into cash. And if you eliminate $100 bills, that of course becomes a lot less practical. Storing lots of $1 bills, if you're a big corporation, is not always easy to do. There's big costs associated with that, costs that may look somewhat similar to storing gold. So Rogoff has a really detailed kind of implementation guide for how to go negative. He elaborated on that in a great book a few years ago called The Curse of Cash. And it's an argument that I think is getting more attention. And Rogoff, among others, feel that this is kind of inevitable. The central banks are going to have to go there even if they don't want to. The Fed's going to have to go there. So, negative rates are something that we need to think about. And certainly that's potentially for bonds, again, at least in the short, which we spent some time talking about in the outlook. Will it continue to outperform Bitcoin? You saw that it was up more than Bitcoin this past month, and it's significantly outperformed it this year as well. And seeing some really interesting things happen in some of the ways that traditional investors gain exposure to Ethereum. So some of you may be familiar with the various grayscale investment trusts that traditional Wall Street investors can access. Folks with retirement accounts in the US can also access. These are ways that you can, with your traditional brokerage or institutional investor relationship, gain exposure to crypto assets. And the Grayscale Ethereum Investment Trust is actually trading at almost a 5x premium to Ethereum's spot price. Interpreting what that means is something we spent some time in the report. I think there's reasons to not necessarily overinterpret the bullish sentiment that this expresses for Ethereum amongst institutional investors, but it is a data point that's worth taking into consideration. Grayscale's Bitcoin Investment Trust has a premium as well, but it's only 17%. Now, there are many more ways for traditional investors to gain access to Bitcoin exposure through the Chicago futures markets, through Fidelity, so on, than Ethereum, and that made part of the story, the difference between the premiums between the two. The Bitcoin Investment Trust is overstate the point here, but it is a pretty interesting data point around the Ethereum Investment Trust. And there's other things we get into in the outlook as well about this trust, about arbitraging it and whether you should consider that. But anyway, the main fundamental drivers of Ethereum's price outperformance in 2020, in our view, are the following. We've seen huge growth in ERC20 stablecoin use. So Tether, for example, is just booming. USDC as well. These are Ethereum-based tokens now. In the case of Tether, it moved over to, or it added Ethereum as a platform, and use of Tether on Ethereum is outpaced. We're seeing, a growing but still immature DeFi ecosystem. Had some really rough bumps in March, but it's survived. And we're also seeing real progress in our view towards the long-awaited Ethereum 2.0 rollout and the transition to proof of stake. Proof of stake may tie up supply, and by tying up supply of ETH, that may put some upward pressure on the price, right? So all these things are probably part of the story of driving ETH performance. Whether or not that's going to continue, you can read the to hear more on that. Bitcoin is very complementary. It's not something you always hear between all the shouting on Twitter, but things like wrapped BTC, starting to outpace transactions on the Lightning Network, the possibility that we might see more Bitcoin volume transacting on top of Ethereum than Bitcoin layer 1, layer 2 solutions. Ethereum becoming maybe the ultimate layer 2 solution for Bitcoin. These are all things that are quite interesting to think about. And perhaps we'll have a happier kind of community, I think, going forward if more people see Bitcoin and Ethereum as more complementary than competitive. So let's now turn to the stock market, and lots of columns written last week about what's going on with the stock market. Is it insane? What does the stock market's performance mean for crypto? So first, just to recap, U.S. stocks had their best month in April since 1987, and there was this great post on social media by Simon Ree. I'm just going to read from. I had this horrible dream last night. I dreamt that a global pandemic had spread across the world and caused a 2-month shutdown of the global economy. I dreamt that there was no cure and no vaccine for this pandemic, and billions of people around the world were placed under lockdown. I dreamt that the global trade had collapsed. My dream got so crazy, I even dreamed that oil's prices went negative, loss of jobs and so on. But then I woke up, took a look at the stock market, and realized that it was all just a bad dream and everything was okay after all. So a lot of commentary about how the stock market seems disconnected from the real economy. And, Hertz, it appears, managed to avoid bankruptcy temporarily. J. Crew went into bankruptcy. Lots of companies are looking at bankruptcy. And you might look at that and say there's a huge solvency problem in corporate America and in corporations around the world. Why isn't the stock market reflecting that? Well, we know from research that stock market performance is driven by a very small handful of outperformers, of star stocks, if you will, the Amazons, so to speak. It's really 4% of the stock market drives a lot of the returns. So you could see some rationality in some ways to how the stock market is behaving, even with all these bankruptcies, this solvency problem that does seem to be affecting a number of stocks. Another point that Professor Paul Krugman made in his column last week, and before I get to that, we've for a long time, this is a bit of a risky comment to make, I suppose, but for a long time, we in the crypto community have struggled to attract more women to the space, and so I don't know if having a slide here comparing Paul and Clooney here together is useful or not. But anyway, the stock market is not the economy that as Paul Krugman points out. People often confuse the two. They're not the same thing. And as Krugman said, investors are buying stocks because they have nowhere else to go. And he makes a comment that what is the main alternative to the stock market? Buying bonds. Yet these days bonds offer incredibly low returns. So Krugman is not bullish on bonds. He thinks stocks are really the last resort for a lot of people. And that explains why, in spite of a big economic problem, you're still seeing the stock market rebound and perform well. Well, we already talked about why the bond market may not be as bad a place to hang out going forward as Professor Krugman thinks. But the other thing about Paul Krugman is probably many people on this call know is he's not a big fan of Bitcoin or gold. And they don't really factor into his framework for where people can invest in times of economic stress and when stocks may appear to be way overvalued or quite risky to own, at least in this uncertain COVID environment. So we encourage. This is our chance to kind of advertise our recent report on gold that we published last week. Actually, I guess earlier this week. It's a primer on both the case for investing in gold more generally, as well as gold-backed tokens. And it also takes a close look at how gold compares with Bitcoin. To give away the punchline of the report, we think if you own Bitcoin as a hard asset, that you really should think carefully about also owning gold in some shape or form, and that gold-backed tokens are actually complementary to many other ways of owning gold, like owning physical gold, which there's still a strong argument for doing as well. So anyway, take a look at the gold report, and the other comment I would make is we're seeing a lot of growing recommendations from various corners of the financial system for both gold and Bitcoin. Jefferies, head of equities, came out recently, recommended people buy more gold and Bitcoin. Elliott Management, one of the sharpest investment firms out there, is plowing into gold. I think there's a decent chance that gold could help drag the price of Bitcoin up. I think they can actually play off each other quite well. So seeing more traditional investors who have oftentimes shied away from owning gold, Warren Buffett has famously not only anti-Bitcoin, he's anti-gold, but seeing some of these traditional, more conservative, value, momentum investor types coming into the gold market, I think could be actually quite bullish for Bitcoin. Okay, so turning now to what's happening on chain, we just wanted to touch on a couple things we're seeing, and these slides leverage our charts, which Nick mentioned on blockchain.com. So deceivingly low transaction volumes. So we have on our website a chart that shows you the confirmed transactions each day, and this is a 7-day average view from March through today, and you can see there's a big drop in March. And traditionally, this would have really raised some alarm bells. Transactions are certainly one of the best measures for understanding actual use of Bitcoin. And seeing this kind of drop might trigger some concerns. However, it's worth pointing out that there's been a real rise in what is called transaction batching. Now, for those of you who aren't familiar with this, it basically is a more efficient ways to kind of package transactions together, inputs and outputs. And we saw a big spike in batch transactions right at the same time we saw this drop in overall transactions. And so you have to dig into the weeds a bit to kind of understand what's going on here and look at the actual number of outputs. And you can see that actually this dotted line outputs is spiking right as the confirmed number of transactions is declining. So in other words, this is not something that should raise alarms. We know Coinbase, for example, started batching transactions in March, and this is all very fine and actually a very healthy thing because it makes more efficient use of the limited block space on the Bitcoin blockchain. So nothing to really worry about there. And the last chart I just wanted to point out was hash rate, which we're seeing rebound back to close to its all-time high in March on the eve of the halvening here. And I think that's a good segue to jump into the halvening or halving. Again, I'm not sure. It'd be fun to run a poll maybe on social media to see if our users have a preference for one of these terms. But let's talk about the halving. And Nick, if you want to jump in here in 8.2, because you've had a front row seat at these halvings, which are very rare every 4 years. Just for those who are still pretty new to crypto and Bitcoin, the halving is basically a once every 4-year event where the reward for mining Bitcoin gets cut in half. And there's been 2 prior ones in 2012 and 2016. In 2012, the reward for mining a block was cut from 50 down to 25 Bitcoin. And then in 2016, it was cut from 25 to the current 12.5. And on the 12th of May, so just in a few days, we're going to see that reward cut for a third time from 12.5 Bitcoins down to 6.25 Bitcoins that will be minted into existence every 10 minutes roughly. And you can see from this chart that Pantera put together that, traditionally, post-halving, Bitcoin's price has done phenomenally well, up over 9,000% after 2012 and up close to 3,000% after 2016. And you can see also kind of before the halving, there's a bottom that occurs, and then the price tends to appreciate, in anticipation of each halving. And we seem to be tracking that pattern, although not as much of an increase, plus 168% this time as last pre-halvening's increase, plus 241. And when you think about the ratio of the change in the ratio of the reward cut, there's many people who think that we're not going to see as big of a percentage increase post the halvening as we have in the past as well. There's other reasons to kind of think that this halvening, of course, is going to be different from previous ones. And we have in the monthly outlook a piece of analysis by Crypto Compare, that goes through why this Bitcoin market is different today in 2020 than it was in 2016 and 2012. Certainly the size of the market the number of participants, the types of participants has changed dramatically. Miners back in 2012 were, the dominant, players in the space. Now you've got, synthetic ways to invest and speculate on Bitcoin. You've got, more institutional money. You've got, just a larger overall total number of coins floating and traded than back then. So there's reasons to think that the halving may be not as, impactful this time as the prior two.
I make a quick
The
point
other
there,
point I would make,
Garrick. And for those that don't know, and this is just to be educational about it, the halving is a very predictable event. And so we basically know when it will happen. And as Garrick mentioned, it will occur on some point of time during May 12th. And it happens every 2,100 or 210,000 blocks. And so sort of a predetermined amount of time. And for us that have been around in the cryptocurrency industry for a long time, halvenings are a little bit like maybe the Olympics or the US election cycle. And they're kind of a time for celebration. It causes and tends to bring in a lot of new interests into the entire community because it brings in a sharp contrast the currency system that underlies the Bitcoin protocol. And so as a reminder, the entire protocol is incredibly transparent. And the total fully diluted supply of Bitcoin was programmed at the very beginning to a fixed amount. There will only ever be 21 million Bitcoin. And as of right now, in this moment, about 18.3 million of those have been minted. And the supply is not susceptible to adjustment or manipulation. And so unlike the currencies that are used by most major governments and nations that change and are fluctuating significantly, the cryptocurrency Bitcoin does not have those things in its design. And so for those that are worried about whether or not there'll be enough Bitcoins in the world, it's important to remember that you can own tiny fractions of them. So you can actually own a percentage or a fraction of a full Bitcoin, and you can actually denominate them out by 8 decimal points. So just like if you wanted to buy US currency, you could buy a whole dollar or you could buy pennies. And if you had 100 pennies, you would have $1. In Bitcoin land, you can buy 1 Bitcoin, and the price of a Bitcoin today is roughly $9,500, or you can buy fractions of a Bitcoin. And so those are some things to understand about it. But for us in the cryptocurrency space, this is a time we all get excited about what will happen. And as the mining reward decreases and more people use it, it puts both supply and demand pressure on it. And if there's less of something that's useful and more valuable, it tends to cause a price increase. Now, we don't know exactly what will happen this time, and there are way more sophisticated market dynamics, as Garrick has mentioned. But in the past, if it is a predictor of any type for future performance, you've seen what's happened, and that's the reason why there's a large media cycle right now that's talking a lot about what's happening with the halving or halvening. And I am going to put out a poll later today, Garrick, to determine once and for all which of these two terms we should be using, because I'm not sure if I feel too strongly one way or another, but I do think the community should speak up. So I'll pass this on to you because I think speaking a little bit about how the options market is betting right now does tell us a little bit about the difference between this halvening and the previous one.
Yep, thanks, Nick. And one thing I would add is, look, I mean, I think the bottom line economic reality of the halving is that it does reduce the rate of new supply, and if demand is consistent, then over time, if demand stays the same or it even increases, of course that's going to boost price. But demand doesn't even have to increase; it can just stay flat. You slow down the rate of growth in supply, and it should have a positive impact on price. So that's just a hard economic kind of fact that helps kind of explain to some degree, I think, how the halving has led to medium term kind of growth in the price of Bitcoin. Nick mentioned the option market. Don't want to spend too much time on this. Options are new to Bitcoin. But if you look at the market, it does seem to suggest that there's a premium being paid for downside protection versus speculating on upside around the halvening. The reason to discount, I think, the options market data to some degree at least, is it's not a fully developed options market. You have to think about who's in this option market and why they're there. We think there's probably a lot of miners who have a lot of capital invested who would be buying downside protection. We've seen, just in March, how fast Bitcoin's price can go down, and that can really drop a big hammer on miners who can't necessarily flip a switch always very easily and turn everything off. So this view here that's being expressed in the options market may not be entirely related to kind of the full market participant view of how the halving is going to perform, and certainly over the more medium term. The other thing too, because I know a lot of people on the call are looking for price guidance, and look, predicting where Bitcoin's price is going to go is very, very difficult. I guess where we'd wrap up before we go to questions is for those of you with a more medium term outlook. I mean, I think this is a really important chart to kind of keep in mind, and it brings some of the macro and broader financial market discussion that we've had on this call back to the table. 8 of the last 10 years, Bitcoin has been the best performing asset. It's beaten every other asset class 8 out of 10 times. And it's setting up to do really, really well this year in this macro environment. And I think over the medium term as well. And so for people who are worried about, will there be a big drop off in price after the halving? Certainly always possible, right? But we think that this is a great looking chart for Bitcoin. We think there's a very good chance that Bitcoin outperforms again this year, and certainly over the medium term, given the current environment. Just as always, be mindful of the volatility, be mindful of how big the swings can be. This is an asset that is extremely volatile, and you need to make sure you size your position in a way so you can stay in the game to be there at the end of the year and participate in some of these great wins. So that's all of our prepared content. We'd love to have discussion, questions.
Great. I think I'll kick off. First question is, last month we spent a lot of time talking about the increase in demand for stable coins. And I wanted to get your view on what we saw over the past 30 days. Did that continue? And what are some of the trends from the past month as it relates to stable coins, Garrick?
Yep. Yeah, absolutely. So that trend has continued. We've got, Tether, USDC, the whole stablecoin group growing. Even Gemini dollar, which has been lagging, is gone. It was sitting at about $4 million of market value for a long time. I think last I looked, it's up to 5 recently. So stablecoins continue to boom. What's driving that is always the big, interesting discussion point, and certainly, the volatility in crypto markets probably drove that to some degree. I think the rise of stablecoin lending markets and being able to earn 8%, 6% or so on some of these stablecoins. The strength of the U.S. dollar, for people around the world who can't easily get access to U.S. dollar banknotes, but have an internet connection, have a computing device, a digital stablecoin is a really attractive way to if you're in Lebanon, for example, which is going through a currency crisis, or you're in Turkey, which is, starting to see the lira weaken significantly, and you're concerned about Bitcoin volatility, but want out of your local currency, a US dollar stablecoin is potentially a really compelling option. And even if you're in the United States, you can't get north of 1% interest really these days on bank deposits. Lending platforms, of course, carry, maybe extra risk, compared to FDIC insured bank deposits, but, that's a pretty big, kind of carrot to attract people to use stablecoins. We are also getting, and again, we'd like to have more robust data here, but anecdotal evidence that stablecoins are also being used more widely in transactions. And oh, by the way, Libra is not dead. Just this week, they announced a major hire, the head of HSBC's global legal team. They, to run Libra as CEO. Someone who's going to be based in DC. He used to work both for the Obama administration and the Bush administrations on threat finance and in the Treasury Department. He's a major heavy hitter. It's a big, big endorsement for stablecoins to have someone like Steve Levy come over and get involved with Libra. And I think Libra is net positive for crypto as a whole. So that was a major development in the stablecoin space. And stablecoins are really booming. And of course, Ethereum is one of the big winners there. That's one of the kind of ways to play the stablecoin game. You may not make money on stablecoin appreciation. They're not designed to appreciate, but there are ways to kind of think about how to invest in the growing adoption of stablecoins that we covered in more detail in our 2019 State of Stablecoins report, which you can download for free on our research page.
Yeah, thank you, Garrick. And I think that it's really kind of speaking true to a thesis that many of us have, which is the internet will be the growth engine for the world's economy. And one of the things we're going to need is a native digital financial infrastructure for that. Sometimes that will mean cryptocurrencies. Other times it will mean the marriage between cryptocurrencies and fiat ones. And I think stablecoins still represent an incredible opportunity, especially in the business sector, for people to basically have dollars without borders. And that means you have stable digital dollars that are able to settle instantly over things like the Ethereum protocol. And we're seeing increased transaction volumes on those protocols and increased demand for stablecoins. So we'll continue to study and watch those developments very closely. And I anticipate we'll be speaking about them regularly. Garrick, one question that came in, and it's sort of a longer one, so I'll let you take it in any direction you want. So we had that headline, is the stock market insane? And I think it's interesting if we just pull back and look at it from a bit of a perspective, which is we had, you said, the highest increase in the stock market value since 1987, with the highest increase in unemployment since the Great Depression. And we're hearing a lot of experts pop on, both mainstream media and in articles that inflation is bad, or deflation is bad, or hyperinflation is bad, or negative interest rates are bad. And I guess to help us make some sense of like the macro there on a historic and economic perspective, can you maybe just suss out some of those terms for our audience today? And then not necessarily make a argument for what is good, but why do we hear these conflicting views constantly? And like, is it just the turmoil of economics to constantly study these things or what is it? Like, help us make some sense of that.
Yeah, that's a big bear of a question. All right.
Sorry, it's probably better for a whole class or course, at some point, but maybe help us make a little sense of it.
Yeah. Well, I just want to, I guess, start by saying that we are in uncharted territory. We're seeing things happen with, central bank policy, government policy, negative interest rates, negative mortgages. Before all COVID, you had like you in Denmark, you could go get a negative rate mortgage. It's a bizarre world we're living in. We don't know what the full implications of all these policies are. We don't know what distortions are being created, with central bank policy, and what long-term consequences of those actions are. We're hearing comments like, the Fed is killing capitalism. It's offering way better terms to bail out companies than Warren Buffett would. That was a comment that came up in the Berkshire, Woodstock for Capitalism meeting this weekend. And by doing that, you're kind of incentivizing the system and participants in the system to kind of think not about making great products and delighting customers, but thinking about how do I lobby the government to get preferential bailout terms. So there's a lot of things to kind of digest in this environment. There's some very scary things too. There's a thesis that a lot of the U.S. economy is driven by consumption, over 60%, right? And to drive that consumption, there's a theory that really stock prices have to keep going up. This wealth effect that the Fed is kind of targeting, arguably, is what's driving policy. No longer are central banks necessarily targeting the economy; they're targeting the stock market to increase the wealth effect, to drive consumption, and that in turn drives the economy. So There's a arguably a kind of a flipping of kind of priorities and targeting that's gone on. It's definitely disconcerting. We mentioned Rogoff earlier. I disagree with Rogoff about a lot of things, but years ago he, I think, correctly argued that it's very dangerous for central banks to send out the signal and message that, hey, stock market, we've got your back. That we're this is a very maybe tempting thing to do in the short run because you're dealing with something so catastrophic as COVID-19. But boy, what are the medium term and long term implications of that? We're just, we don't know. Deflation, inflation, like we talked about, boy, the market's saying that, we're going to see prices decline, or, this kind of disinflationary environment. Is that a bad thing or is that a good thing? Again, this is something there's a lot of debate, in economics about. For a lot of people, the idea that prices going down when economic times are tough, that sounds like a healthy thing. The problem, that economists, who are kind of running the show at central banks today, we've got a lawyer, though, at the top of the Fed and at the top of the ECB. Everyone remembers the 1930s and the Great Depression. And when you get into a deflationary cycle where prices are going down month after month after month, you get this tendency to not want to spend. You think you're going to get a better price on that house the following month. And that can lead to this kind of downward cycle. And that's the great fear that has dominated macroeconomic thinking for decades. We've got to avoid deflation. And the concern is that you overshoot with a stimulus to prevent deflation and trigger inflation or hyperinflation. So, I think, what's happening with the gold market, what's happening with Bitcoin is a reflection of growing concerns that central banks will be able to stave off any kind of deflation. They'll do whatever it takes to make sure that doesn't happen, and they're willing to risk inflation on the back end. And I'll stop there because that was a long-winded response.
Thank you for that. We'll make sure you get some water so you can catch up. So yeah, I mean, it's definitely sounds like, and without a doubt, we're in a historic period of time and in uncharted territory there. And I think for context, 8 years ago when we started blockchain.com, we were kind of coming out of the ashes of the last financial crisis, and helping people have control over their money was really one of the things that bound so many of the early crypto community members, especially within the Bitcoin community, and then later into the Ethereum ones and others. And so, the mission for our firm is basically to make it possible for all people, regardless of where they are, to be able to perform basic economic activity with one another on a peer-to-peer level, and not have all this infrastructure and these other things that coerce or interfere in activity. And so we still are a long way off from achieving the dream, but this is a moment that is pretty interesting for the ability for people using technology now to transact with each other anywhere in the world effortlessly and nearly for free. I think presents a very compelling alternative to the status quo. So we have a bunch of other questions. One of them that's slightly related to the last one. If there is going to be, basically the Bank of England just signaled they're going to print another 100 billion. The Federal Reserve has unlimited quantitative easing, and all of this is to stave off deflation. So we can expect probably some level of inflation or even maybe hyperinflation, which would be interesting. Like, what do you think that does for crypto? And how does that impact Bitcoin and other cryptocurrencies? What are your views there?
Yeah, I think it's real simple. You've got this number of things out there that you can buy with money: house, food, whatnot. And you've got the quantity of currency to buy it with. And when that quantity increases, prices are going to go up. That's prices of lots of things: prices of stocks, perhaps prices of real estate, prices of gold, prices of crypto. It's not a very complex formula or relationship, I think, for most people to kind of wrap their heads around. The time frame that takes place over is always tricky, and also the things that you might think are going to go up may not go up, and maybe something else goes up. My PhD supervisor, Neil Ferguson, and a number of other people after the 2008 financial crisis all co-signed a letter wrongly arguing that core price inflation was going to go up dramatically in the wake of QE. We didn't see, core inflation go up that much. Why is something that we're still trying to understand. There's been massive deflationary pressure from all this low-cost labor coming to, out of the hinterlands in China to the cities. That's helped keep prices down, more efficient manufacturing, so on and so forth. But we did see prices of things like healthcare and education and asset prices certainly going up. And so, you may not see some things go up in price, other things might. But I think overall, it certainly is helping to make the case for hard assets, all the central bank activity. And the Bank of England in particular, I'll just say this one more thing. I mean, they came out with their inflation forecast, for next year, and it, the Bank of England is not, a group of epidemiologists or kind of public health officials. And I think trying to make longer term economic forecasts, is I don't take comfort when I see that. It makes me wonder if they're trying to spin it, and there was a lot of positive sentiment being by the Bank of England. And it's a concern that I have, frankly, when I see economists not acknowledging what they don't know and can't know, given the uncertainty around COVID-19.
Yep. So there's a question here that I'll take. And the question is, can you provide your latest thoughts on market structure development and trading via self-custody wallets? So for those that don't know, there's a whole spectrum of custody in cryptocurrency land. Everything from self-custody to you in a device where you can have a hardware wallet, to putting your cryptocurrency into a managed solution, something like a cryptocurrency bank, where they are the custodians of your funds. And so there are different risk profiles with each of those options. Many people choose to trade on a centralized exchange and then move their funds to a wallet where they want to hold them for safekeeping. And that's one of the preferred ways of trading and storing cryptocurrency, but everyone should go explore what makes best sense for them. It's hard to tell exactly how much trading is happening via self-custody wallets because of the security design for those things. And so I can speak a little bit about the blockchain.com wallet. It's the world's most widely used wallet. And on any given day, roughly 30% of all on-chain Bitcoin transactions originate from blockchain.com wallets. So I can say that over the past 30 days, we've had some of the highest on-chain transaction volumes we've seen in the past year. The mempool is getting backed up occasionally, which means that there's so many people trying to move Bitcoin around that there's actually delays on the network. And many of the exchanges are posting very, very high volumes as well. So generally speaking, you're seeing an increase in activity. Some of that may be related to a positive news cycle or a response to the current economic situation. And obviously there's a bunch of things probably causing all of that all at once. But that's my view there. We're also seeing increasing volume on the decentralized protocols, which is pretty interesting as well. We had a question here around just some kind of advice around whether or not it makes sense to invest in more than just Bitcoin, or what other tokens or cryptocurrencies are ones that should be considered. Ultimately, we're not here to provide investment advice, actually, and it's important that you study each of these different projects and protocols and understand why they exist and what the value proposition is and how their economics function. My view is if you have a certain belief and you think that having a fixed amount of a currency supply and then an increase or steady demand, and you understand the pricing dynamics of that, and you have conviction for it, then you should pick out cryptocurrencies that find or marry some of those similar value propositions. And so, long story short, there, and there's another question here around whether or not we're going to be listing more assets either in the wallet or on the exchange. We're always assessing new assets to offer to the blockchain.com community. We've had long debates internally here about whether to just allow people to have whatever they want and add all the things, or whether we should curate that. And at the end of the day, it's always a trade-off between offering different things that may not have a lot of long-term value, and supporting those comes at a real cost. And then ultimately, we want to specifically have high quality assets available and features for our community. And so we take a little extra time to study those before we offer them. The blockchain.com exchange has lots of different pairs of many different digital assets and cryptocurrencies, including a digital gold product that has tokenized gold stored in a vault in Switzerland. And that's a partnership between Blockchain, MSK, which is one of the largest gold custodians in the world, and CoinShares as well. So let's see, we've got another couple questions here. Let's see if we can get one that's interesting for Garrick. Well, there's a question here that came in, is why is Bitcoin not available in some countries? It's very hard to completely censor access to cryptocurrency, but policymakers do take a different position on these things, jurisdiction by jurisdiction. There aren't too many places that Bitcoin is actually banned or illegal. There are some places where it's discouraged to use, and some of those countries having a list here include places like Algeria, Bolivia, Bangladesh, and I would expect those places to probably revisit those positions in the long term. But just like many things that are new, oftentimes sort of confuse policymakers, and it takes a while for them to adapt their positions. Cryptocurrency has certainly been on a long learning journey with policymakers around the world, but for the most part, you've seen a relaxing set of rules, I would say, around that. And there are millions of people that use cryptocurrency every single day across Europe, across North America, across Asia, in Africa and South America, and really around the world. So there's an ever-growing and vibrant community.
Yeah, I'll just add to that, because we mentioned Libra. I think there's been just a massive difference in response to Libra, which was, really, we had David Marcus dragged in front of U.S. Congress and kind of really taken down by a number of, Congress people, and Europe has been howling about Libra. I think you're much more likely to see real resistance to the introduction of Libra in many markets than we've seen in, for Bitcoin, for a whole number of reasons. As Nick mentioned, Bitcoin isn't really, banned very many places. It can be harder to, to link your bank account to a Bitcoin exchange in some markets.
Yep.
But that's kind of really, I think, the main difference around the world. Part of it comes down to, I think, what Bitcoin is, and it's open source software, it's decentralized. It's something that supports things like privacy that a lot of people politically agree with. It's also something that's not today is widely used as a currency, is more of a hard asset for many people. And something like Libra and stablecoins, and we've talked about this in our stablecoin research, kind of move more into the wheelhouse, arguably, potentially, than, of central banks than something like Bitcoin, at least in the near term. And so the regulatory reaction to Libra, compared to Bitcoin, is not a surprise to me at all.
Yep. Some more questions around what types of altcoins should be considered for investment this year. I guess, when you think about, when we look just at the demand on the blockchain.com exchange, I think that really shows significant sentiment for where the real investment thesis is right now still. And you just need to look at the volumes. The vast majority of trading in the cryptocurrency space really is between the fiat pairs in Bitcoin and fiat pairs in Ethereum, and then between Bitcoin and Ethereum. Now, that's not to say that it won't always be that way. Just like there's not one flavor of soda that people like, there are many different flavors. But right now, the vast majority of trading volume is really against those two protocols and the different features that they provide and assets that they have on top of them. And so when you make assessments about whether or not to potentially invest in things, it's just very careful about whether or not those things have real robust communities, the governance structures of those projects make sense. And I would be putting a real word of caution out to people that are looking at alts in general as investment opportunities, and just do your homework, because there have been many projects that have come forward with fancy marketing, but not always very fancy economics, and usually not very fancy technology. Okay, we're gonna pause there, and I wanted just to recap the things we covered over the course of this. So we recapped why Bitcoin is outperforming gold, but not bonds. We took a look at Ethereum and whether or not that will continue to outperform Bitcoin. Looked at the stock market, what's happening there, and what it might mean for crypto. We saw that drop in transaction volume on chain, but then we also pointed out that you saw an increase in batching of transactions. So there's really not much to worry about there. And then the hash rate heading into the halvening is at nearly an all-time high, which is pretty encouraging. And then, of course, the very exciting event coming up just in a couple days, where the reward for mining Bitcoin will go from 12 to 6.5. So we are going to watch a lot of things, and we welcome you guys to follow up with us. We'll be posting a blog with this really in-depth overview of everything that Garrett covered today. I want to thank him and the research team for putting that together for the community. And we'll be hosting this up on YouTube as well for anyone that wasn't able to get to us. So thank you guys again, and thank you very much, Garrick, for sharing your insights. And Professor Garrick, we always welcome your insights. Thank you very much.
Thank you. Pleasure.